If you're near retirement or in retirement, you need a multi-year tax projection. I'm going to explain what that is and why through a real-life planning scenario. Got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corehorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, you have tax preparation and tax planning. Tax preparation is a requirement. It's something we all have to do when we have income, and you do it retroactively. You don't think about it like this, but you do it after the fact. So it's reactive. You're getting the right number in the right box, and you put it all on this form in a certain way that the IRS instructs you to do it, and essentially it tells you how much tax you owe, what tax bracket you're in, and so on. It's completely reactionary. Tax planning, however, is proactive. It's in advance. It is thinking ahead. Well, what might my tax picture look like? And therefore, what opportunities exist for me to improve that tax picture so that, I can pay the, less taxes this year, or how we say it here is pay the least amount of tax over your lifetime. Sometimes that includes paying a little bit more tax this year, really paying the most tax possible in the lowest possible brackets. And therefore, if you look and say, hey, I'm in a low tax bracket this year, maybe you do some Roth conversions or you invite some taxes, some income into this year, all with the aim of exploring what opportunities exist for you to pay the least amount of tax over your lifetime, and through the financial planning process, implementing the right strategies. And so oftentimes, I would say that tax planning, I would summarize it in you've got two objectives. You're trying to avoid surprises, no one likes a tax surprise, and identify and capture opportunities. So avoid surprises, identify and capture tax opportunities. So how do you do this tax planning? Well, normally a formal approach to it is in the fall, so maybe around right now, but it doesn't need to be. You could do it, at the beginning of the year or whatnot. But whenever you're curious and need to start looking at these strategies, is to do a tax projection. I know I'm throwing a lot at you, a lot of tax, and so a tax projection is doing a forecast, having some sort of forecast of what you think this year's tax picture is going to look like, even though it's August or September, or even though, it might be June or whatever, kind of projecting out what your paychecks will amount to, what your gross wages, what your taxable wages, what your withholdings will be, projecting out whether you'll have dividends, interest, capital gains, all that sort of stuff, whether you're on Social Security, whether you've made any withdrawals from retirement accounts, projecting all of that out and laying that out on a tax return. We do it either in our tax software that we use to serve clients with, or we've got a few different Excel modules where basically we can project out a tax return, what it would look like, standard deductions, all that sort of stuff to determine, okay, well, what tax bracket will you be in, what will your tax amounts be, and so on. So that's a tax projection. And that projection, that analysis of here's what it looks like your tax picture could be this year, that helps make it really objective. Well, you're going to be in the 12% tax bracket, therefore I would do Roth contributions, or let's do a Roth conversion to get you to the top of the 12% tax bracket, or your health insurance is through the Affordable Care Act, therefore we want to keep this adjusted gross income, your AGI, as low as possible to get premium tax credits. You said that AGI was going to be this, currently we're showing it's going to be this, so you'll get some premium tax credits back. So it makes it a little more tangible, a little more real for you to see what the planning strategies are. So that's a tax projection, part of tax planning. Taking things up a notch, if you're a fan of the Wise Money Show, you've heard us talk about for the past few years that you need a multi-year tax projection. You need that. Let's project out what this year's taxes will look like sometime earlier, middle of the year. But you actually need to apply that for a few years forward, projecting out what each of the subsequent years will look like based on what you know right now and what we know about tax breaks, tax brackets and tax rates and so on. What we know about those moving forward, here's a multi-year tax projection so that we can see changes. Why would you do that? There's just several reasons for it, but just had a client scenario where sort of the top 3 reasons came immediately to life. Client scenario is she had just retired and he was going to be retiring, about the end of this year, approximately. And so we first wanted to do a tax projection to see, well, with her retiring and getting on Social Security, will there be enough withholdings? Because obviously that's a big change, right? Changes in income, but also changes in withholding. So what tax bracket will they be in and so on? But are we setting ourselves up for a tax surprise? And so needing to do that tax projection for this year was vitally important. And, there was going to be a small surprise. It looks like they're going to owe about $1,000. So I just need to prepare them that they probably will owe, and make sure, that isn't a surprise to them. But the next thing is we then wanted to look at, okay, so for next year, he's not going to work, she's not going to work at all. They're both going to be on Social Security. We're going to start some withdrawals from IRAs. What tax bracket will they be in? And it was showing that they were going to be a little bit into the 22% tax bracket, not really even close, but near the bottom part of the 22% tax bracket. So I wanted to model out using this multi-year tax projection, doing Roth conversions. For the next few years, what if we did some Roth conversions to get you to the very top or get you higher in the 22% tax bracket, since it looks like, hey, in a default scenario in retirement, you're going to be in that 22% tax bracket regardless. Let's do some Roth conversions early in retirement when you're still in your mid-60s, so that those dollars can then be positioned to grow tax-free moving forward. So this multi-year tax projection allowed us to think through, well, let's do X amount of Roth conversion, or let's plan on it, right? You're not setting anything in stone, but let's plan on doing X amount of Roth conversion in 24, 25, 26, and so on. So it helped us identify a Roth conversion strategy. Coupled with that, like, these aren't really independent, but in doing that multi-year tax projection, we were able to take a look and do some IRMA planning, some income-related monthly adjustment amount planning. Because if we're looking at doing Roth conversions, we've got to be very sensitive or very aware, all right, in getting your Social Security, getting your pensions, and drawing enough out of your IRA for you to live on. If we also do Roth conversions on top of that, how close are we going to be to that IRMA threshold? And you might say, there's no way to do a multi-year tax projection because we don't know what the IRMA thresholds are going to be out there in the future. You're right, but we know what they are today. And we can at least say, well, what if they don't change, or what if they don't change that much? What if they at least don't go down? Let's try to make sure your adjusted gross income or modified adjusted gross income stays below this level. We're doing Roth conversions up to that threshold or just slightly below to make sure that we wouldn't be subjecting ourselves to IRMA. So the first reason we were doing the multi-year tax projection, Roth conversion planning. Second is IRMA planning, IRMA avoidance. But then coupled with those two is we were really also doing required minimum distribution planning, RMD planning, because this multi-year tax projection, again, we laid it out where you're going to be in the 22% tax bracket. And they might change that threshold to 25%, and you're early in retirement. So let's do some Roth conversions. Then want to make sure we do enough where it's meaningful, but we don't threaten IRMA. Yep, okay. And then if we do this, what will your RMDs look like out there at 73, and will that subject you to IRMA, or will that put you in the next tax bracket, and so on? And we were able to project out that doing X amount of Roth conversions for these next few years avoids IRMA, and then out at 73, when RMD starts, that's not going to push you above the IRMA threshold either, and doesn't look like that's going to put you in the next tax bracket as well. So right now, in their mid-60s, not only did we need to do today's tax projection to see if there was going to be any tax surprises, but that multi-year tax projection, we took it out about 10 years to see how much in Roth conversion should we do? What's that strategy? How can we make sure we avoid or limit the chances that we'd be subjected to IRMA? And can make decisions today to help benefit and improve and limit our required minimum distribution out there in the future. So guys, it sounds very geeky, but do you have a multi-year tax projection? If you're close to retirement or in retirement, you need one. A multi-year tax projection to help you avoid surprises, capture opportunities, and fulfill on that, one of the core 6 areas of your financial life, and that is tax planning. Work with your CFP, make sure they're helping you with all 6 areas of your financial life, and if you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.